Hi, I'm Mike Sibley, leader of the James Moore Manufacturing team. On this episode of More on Manufacturing, we're joined by Scott Thomas, CFO at James Moore and Company and leader of our outsourced CFO services. On today's session, we'll be discussing how to utilize forecasting and budgeting in your organization and also how it supports growth and profitability and increases the value of your business. So, Scott, welcome. Appreciate you being on today. I know you're going to have a lot of valuable insights. So let's just jump into it. Let's. But before we get into forecasting and budgeting and things like that, let's first talk about just overall for an organization having a strategy, setting some goals, even a strategic plan. I know for some people that's they hate that's a big endeavor to do a strategic plan, but having a strategy, having some goals, and then we'll talk about maybe how forecasting gets into that. But maybe first hit on that first part.
Sure. I think I always think about strategy can kind of feel big and onerous, but really, if you think about it in terms of things that are familiar to you, um, it's a lot like if you're going on a family trip. You don't just get in the car without packing bags or filling up the car with gas
Hmm.
and knowing a destination. And
Oh,
that's
so I'm doing it wrong then. I'm doing that wrong then.
exactly. Well, at least you probably know where you're going and you have a vehicle. And
Right.
so, in this analogy, the vehicle and the family is the business,
Hmm.
and the strategy is your plan to get to wherever you're going for your family trip. And without having some sort of framework through which you're driving your business, pardon the pun there, uh,
Hmm.
you don't really end up getting to where you want your organization to be.
Hmm.
And um, having goals really help focus an organization and keep you from being distracted from where you want to go. And one of the most important things that I see in having a good sound strategy is not necessarily the way you present the strategy or the pretty graphics that go with it, but is really in creating that framework to tell you what not to do. And it helps you in staying aligned with where you originally intend on going and help you actually get to those destinations along the way.
Okay. Yeah, and you're absolutely right. And I think there are very there's a lot of books and a lot of things out there on how to do it without being overwhelmed with setting these things. But I'm a big proponent of, setting your annual goals and then breaking it down into chunks of, okay, here's what we need to accomplish this month. Here's what we need to accomplish to meet our goals for the first quarter, and then the second quarter, and so on and so forth. You break it down into pieces so that way you've got something manageable that you can accomplish throughout the year.
Exactly.
So, okay, so within that, jumping into sort of the CFO realm of things, and we hear a lot about forecasting and budgeting, and one thing, let's talk about a little bit what's the difference, but also so what is a forecast, what is a budget, and how does that work within the framework that you were just talking about?
Sure. Yeah, I think the forecast or budget, broadly speaking, is the metrics that you put around the planned execution of the strategy. And kind of going back a little bit on the strategy is that there's two pieces to the strategy. One is the creation of the strategy. The
Hmm.
second, which is more critical, is the execution of the strategy.
Hmm.
And what forecasting can do for you as it relates to strategy execution is give you some tools to help analyze the effectiveness of your strategy execution. And within forecasting, I think there's a number of different ways you can talk about forecasting. Forecasting, one piece of that is going to be your annual budget. And we'll talk a little bit more about the value of an annual budget. But I think the first thing you need to do after you've created your strategy and your execution plan is put together a financial forecast that illustrates what you're planning on doing from a financial perspective to as you're executing on the strategy. And then falling down is down the ladder of detail, you move into the annual budget. And then
Hmm.
from there, you pull into a cash forecast to make sure that you're going to have enough money for payroll and to buy raw materials and to pay your vendors, and
Hmm.
that you're actually collecting on the materials you're selling to your end use customers.
Hmm. Well, and I think let's talk a little bit about the important. when you get into ideas like working capital, right? So most manufacturers I would work with are, tend to believe they're or going to try to grow, right? So growth just doesn't. Growth is a little bit scary because you do have to have a certain amount of working capital to deal with things like purchasing raw materials in advance, and then payroll before you get into production, and then you get into production, and finally you get to the point where you ship it, and then you've got terms on with your customer base. So you've got a period of time there. So I guess getting into that cash flow forecast a little bit, maybe you can talk a little bit more about how that helps understand these kind of needs.
Sure. And that makes me think of somebody years and years ago talked to me about the fact that accounts receivable, while it's an asset from a accounting perspective, it can be a liability if you don't manage it correctly. Similarly, an accounts payable can be an asset to you as an organization if you manage it properly. And what I mean by that is accounts receivable is an asset, but only to the extent you're able to generate and turn it into cash. So
Right.
there's kind of two main pieces as I think about accounts receivable. One is it going to ultimately be collectible?
Mm-hmm.
So that's the first piece. And then the second is, when is it going to be collectible? And you,
Mm-hmm.
you mentioned a little bit about, supplier terms or vendor terms. So every dollar you have in AR is a potential to turn into cash, but the more you reduce cash, the more you reduce AR, the more cash goes up. Likewise, the more you're able to get favorable payment terms from your vendors, the more you're able to preserve and conserve cash within your organization. So it's a balancing act, and that's largely, as you think about working capital, the balance of that. And yeah, it's depending on industries. If we're talking about manufacturing, we're talking about raw materials and inventory. So those two pieces and work in progress, those three pieces in addition to AR are key to your working capital management on the asset side of the ledger.
Right. And so, when I'm putting together these cash flow forecasts and working through that, it's the challenge of saying, okay, will we have with this growth and this timing, will we have enough cash, without, to be able to handle this growth, and maybe utilize a line of credit, and how to balance all of those things can be really, really complicated if you're not kind of thinking ahead and saying, okay, well, how are we going to manage this? And to me, that's, one of the main pieces of being able to drive this forecast into a budget and into a cash flow forecast, is you can understand and look out for these potential hazards as they're coming down the road here.
Right.
I guess we'll stay on that traveling theme. So, it's, where's the accident that's going to stall you out there? And that's, to me, one of the major things. But I also think that, you set a budget, and okay, you set it aside, but how often do you look back to say, okay, this is what we were thinking we were going to do. This is what we really did. What's going wrong here? And how
Right.
important is that, when you're looking at it?
Well, I think important thing to realize is whenever you're doing a forecast, as soon as you put the ink on the paper or the virtual ink on the virtual paper on your screen, it's wrong.
Mm-hmm.
Uh, that being said, you hope it's mostly right. And so as you go forward, you need to recognize no forecast is perfect, but again, it's a guideline, it's guardrails. If you want to continue on the traveling thing, and if you start veering into the guardrails, then you make you get some feedback from the guardrails, and it can give you an indication of, well, wait a second, I'm not on the road I thought I was on. Maybe I need to do a little more steering and not be looking at my phone while I'm driving. Or there may be weather ahead that I didn't anticipate in the forecast. It's all sorts of um, expected changes as well as unexpected changes you need to consider along the way. And having that virtual roadmap of a forecast helps you determine kind of where you are on the journey.
Well, I think that's a great point, because basically, when you use the analogy of a phone, right? In fact, I've been driving all over the last couple of weeks, and can't tell you how many times I saw people on their phone veering, through the lanes there, driving 10, 15 miles an hour speed limit. And you just shake your head like, man, this is, they're distracted, and so getting to that same point, a business owner, management can get distracted by the shiny new object or, something else, and not stay within that. And so I think you're absolutely right. The forecast helps keep that focus on what the strategy was, and vice versa. The strategy and the forecast kind of work hand in hand to make sure you're not getting distracted.
Oh, and I think that kind of goes back to the point I was mentioned earlier about strategy. An important part of strategy is telling you what not to do.
Mm.
And so, again, we're just going to beat this dead horse of this road trip. If your road trip is that we're going to pack our meals and not stop at fast food, well,
Mhm.
you know that's going to tell you when you see that Chick-fil-A or McDonald's or whatever it is you fancy. It's going to help you keep focused and stay on the road and keep making good time on the journey because your strategy was, hey, we packed sandwiches there in the back seat. That's our lunch. We're not getting fast food. Let's keep going. So similarly, if you're a manufacturing business and you have an opportunity to hire a whiz bang young person that is a computer engineer that has nothing to do with your business, you're not going to hire that individual. Well, whether you're conscious of that or not, you know that's part of your strategy. Your strategy is to manufacture whatever it is you do, and it's not to get distracted by you know veering off into a business that is not part of your core foundation and part of what makes you different from your competitors.
Yeah, absolutely. So you must have talked to my wife at some point because I'm a big proponent of packing that lunch and going straight through it. We can, you get that 8 hour drive. I don't want to stop if I can help it, right? But let's talk a little bit then because we can dig this down a little bit deeper into the accountability side of things. Now we have a range of listeners and clients who are from very small businesses who can still benefit from using budgeting and forecasting in their own business, even if they don't have multiple departments. But then we've got a lot of mid-sized and larger companies that do have department heads and people that are kind of responsible for cost centers. And to me, one of the important components of a business is when you can get those managers involved in the discussion and have them have accountability, but also ownership. So to maybe talk a little bit about the accountability and the ownership of getting those managers involved.
Sure, and I'll talk about two books that kind of come to mind as it relates to accountability, and I think that the flip to accountability is engagement.
Hmm.
Um, and so the first is a book called The Oz Principle, and basically it's an allegory using the Wizard of Oz about accountability, and it really ultimately it says you can if you're not thinking in terms of accountability, you have a blame culture. Um, and in that blame culture, you say, well, I couldn't meet my goals for the year because I didn't have enough resources to do it. Um, or the CFO told me no for everything. Well, um, in an accountability culture, you see the problem, you own it, you do it, and you execute on it. I may have messed up one of the steps on the road there. Apologies to the authors of Oz Principle, but basically, what the budget does is allows a a cost center head or a functional head or department head or a CEO, depending on the organization, to have a measuring post through which they can determine where where they are and what they can do, and then again, appropriately executed, the budget will provide a means to determine um, the ability to do trade-off analysis. And so I'm giving you, Mike, $100 to go with your marketing plan. Well, I, as a CFO, am not best positioned to make decisions on how to spend that $100. You, Mike, the marketing individual, is best suited. And so the second piece to that is another book that I really like. It's called Drive by I think it's Daniel Pink. And what it talks about is employee engagement and motivation. And there's in his terms, there's three things that drive employee engagement. One is autonomy,
Hmm.
second is mastery, and the third is purpose. The first I'll talk about is autonomy. And if I give you, Mike, the marketing executive or director or whatever we're talking about in this example, the autonomy to make decisions as to how to best affect your marketing plan
Hmm.
within the broader context of the strategic vision that we've articulated to the broad company. You now have more autonomy and therefore you're more engaged. And so the and it's a little bit scary from a leadership perspective to push down decision making into the organization, but you get so many returns far above and beyond what you might expect because you have a much more engaged workforce. You have better decision making because the right people are making the decisions. Um, and I think the critical piece that goes with all of that is communication. Just because you push down decision making doesn't mean the communication doesn't come back and you know what you're talking about.
Hmm.
Um, but yeah, that's kind of how I think about budgets in the context of accountability. And I think it's not just an exercise once a year where you throw together a budget and you put it on the shelf.
Hmm.
The the value of a budget is in that feedback loop where you're saying, all right, we're 6 months through the year, you've spent 47% of your budget. You know, what are your plans for that remaining 53? You know, are we only going to spend 47 in the second half? So then we have a 6% surplus. Well, then that flies back to incentive compensation potentially if you come in under budget. So it creates a nice feedback loop so that you're getting information back to help identify the value of your decision making.
No, that is absolutely great points, and I think I appreciate the references to the books too. I think that it's always very helpful for to to kind of give more insights and ways to look into those things. So let's switch gears for a minute and kind of finish up on really what's one of the overriding themes of more on manufacturing is driving growth in business value. And it's really important. A lot of the clients we work with, whether they want to sell their business or transition their businesses in the next year or two versus the next 5 or 10 years, no matter what, it's still about, okay, how do I grow the value of my business? For most business owners that we work with, their ownership in this business is their single largest asset. And so it's going to be their retirement plan someday and all that. So I want to talk about how forecasting and this employee engagement, this management engagement and budgeting, all that can really support the growth in business value, not just maybe at this moment in time, but over time, really.
Well, I think you know, again, circling back to the strategy is helps you remain focused and not get distracted by things that you shouldn't be doing, and focusing on your core advantages in the market. And so that's sort of fundamental piece number one. Number two, and I'll go to where I like is dollars and cents,
Mm-hmm.
is having forecasting and budgeting. It shouldn't necessarily, a budget shouldn't necessarily be a four-letter word. I know it's not, it's 6 letters. Uh, but I think if it's viewed as a valuable tool and resource, we talked a little bit about employee engagement and buy-in and good decision making. I think the other pieces on forecasting, it can tell you if you have enough capital in your business, whether it's short-term capital or long-term capital, and it can help you make decisions about investments down the road and where that money's come from. If you need to build a new uh, manufacturing facility or need a new piece of equipment in your manufacturing facility, knowing when that's going to come in your long-term plan gives you the lead time to determine where your financing is coming from. Are you going to be able to finance? Are you going to be able to pay for it through internally generated cash flow, or are you going to need to go into the external markets, be it through the bank market or private investors, to bring in capital to finance this? And then the last piece of that is whatever the financing is, am I going to be able to pay off that financing over
Mm-hmm.
time? Whether it's interest and principal payments on a loan, or if I need to bring in private capital, whatever the return requirements are for that private capital. Uh, yeah, the 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 value of the forecast is not the forecast itself. The
Right.
value of a forecast or a budget or a cash is the information it provides to you to help make good decisions to run the business. And I think organizations can get wrapped around the axle, again, going back to the driving thing, can get wrapped around the axle of focusing on the budgets and the forecasts and not what the budgets and forecasts are telling you to help make decisions along the way.
Now that's an excellent point. And as you were talking, I was thinking about even, I've seen companies in the past, all of a sudden go out and purchase some big piece of equipment. Next thing you know, they're trying to sell their business. You do not get that ROI. It costs you money in those kind of cases. And if you're not properly planning that out, you can spend all this money on growth that you're not going to get that ROI, because when you're selling your business, it's about where you're at right now, not what you're necessarily going to do in the future. And
Right.
and so that completely makes sense with what we're trying to do in supporting our clients and advising them on these kind of things. So great points there. Well, Scott, I appreciate we're kind of getting to the end of our time here. I really, really appreciate all your
Sure.
insight today. I know they're extremely valuable. They're different perspectives. So thank you for your time today, and for all our listeners, thank you for listening. And I hope you have a great holiday period coming up here, and looking forward to presenting more of these topics in the new year.
To learn more about James Moore & Company's manufacturing services, go to jmco.com. And don't forget to subscribe to our More on Manufacturing series to receive updates when new videos and podcasts are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us on our website. You can also follow us on social media for more news as the landscape on manufacturing continues to rapidly evolve.